Good afternoon, everyone, and welcome to Pioneering Pensions. For you who don't know me, my name is Stefan Lundberg, and I have a passion for pension. The reason for that is I think pension is important. It's a social infrastructure that everybody needs, but also implementing pension in a good way is not easy. It's a bit like a decathlon. You have to be good at many different things at the same time. So the whole idea with this webinar series is to meet people who have pushed the boundary, done some extraordinary in their field of expertise. I have one, well, if you want to ask questions to Keith, who is our guest today, feel free to type it in the chat on the right-hand side of your screen so that you can, during our conversation, you type it in and we're going to have ample of time after our conversation to answer your questions. So our guest today is Keith Ambachtsheer. He's one of those pension profiles that doesn't really need an introduction because everybody knows him. And so instead of giving a long introduction, I'm going to say why I really admire Keith, because I met him about 20 years ago and we've been discussing since then. Keith has a way of actually putting the finger on what really matters, and he's not afraid of backing away and actually he can bring the uncomfortable discussions forward. And he's helped a lot of large pension organizations to actually deal with their issues. And he worked with all the big pension funds in the world. And he also started the International Center of Pension Management in Toronto and CEM benchmarking. So Keith, welcome to Pioneering Pension.
Great to be here. Thanks for inviting me.
Thank you, Keith. You gave me the opportunity to look at your upcoming letter. And in that one, you talked a bit about how you have evolved your thinking. And I think the summary is you say, what we need is less physics and more sociology. Can you give us a bit of an update on your journey, how you sort of got there?
Right. So in its wisdom, the CFA Institute launched this Verton Award 25 years ago. And it was an award, the recipients had to make some lasting, important contribution to research and investments. In celebration of the 25 years, they just came out with a book. So my letter, which I write monthly, is about these, what it's called the investment luminaries and their insights. So what I do in the letter is to kind of look at the 23 awards that have been awarded, and pose the question: what are they telling me? You know, what's the message here in these awards? And what came to mind is something I read by George Akerlof, who's actually not one of the award winners. Is this notion of where he argues and is concerned about academic, economic, and finance having become too hard, too physics oriented, where everything is dependent on databases and mathematics and proving things statistically. And that in that process, we've kind of lost the softer side of what we should be thinking about: human behavior, dynamics, how things change over time, et cetera, et cetera. So what I did was to roughly divide the 23 awards into the hard ones and the softer ones. And so the timing is important here, of course, because you know, the sort of the hard revolution of finance, portfolio theory, efficient markets hypothesis, et cetera, started in the 1960s, about 30 years before the award. So not surprisingly, a lot of the award winners made some contribution to this hard version of finance and investing. And it was only later on that some of the award winners started to get awards for looking at the softer side of investing. And for example, the first, I think, major example was Andrew Lowe with his adaptive market hypothesis, where he said, now, wait a minute, you know, the assumptions around the efficient markets hypothesis are interesting and important, and the conclusions are interesting and important, but the real world's not like that. The real world is dynamic. It changes over time. and we have to adapt over time to changing circumstances. So we can't be stuck in one place. And then it went on from there, and other contributors added dimensions to this notion that we can't be just stuck with one theory that's static. We have to evolve through time as the world changes. So that's the effective message in this letter.
Thank you, Keith. And I think now is a good point to actually look at the questions we both asked you the last time. So instead of me repeating the question, why don't we just roll the tape?
I've discussed some of these issues with Keith, just the two of us. So I'll now make public what I think is a point of disagreement and ask him to justify his position, which is he's in favor of a particular style of Canadian pension fund. And his belief is that they can beat the market, that they can outperform in their investment management the average performance of pension assets or assets in general. And my question to him is, why does he believe that? I mean, because there's so much evidence that even the professionals, with very few exceptions, if any, can beat a passive investment strategy. And Keith seems to be defending their ability to pursue an active strategy that's going to outperform passive. So what's the justification for that?
Over to you, Keith.
Okay, so that's the question. My two heroes that evolved and are sort of part of my thinking over time are John Maynard Keynes and Peter Drucker. And Keynes sort of on the whole investment economics, dynamic thinking time, and Drucker on the importance of organizational effectiveness to get things done. And that sort of the evolution of my thinking around pension issues has been bringing those two ideas together. So one of the key things that when I went back and read Keynes again, importantly, chapter 12 in the General Theory, which he wrote in 1936, was he wrote one chapter on his investment beliefs. And they weren't just theory, they were based on the fact he ran the Cambridge University Endowment Fund for between 21 and 46. So he actually had some practical experience. And one of the key things that he said was, I'd learned the distinction between beauty contest investing and longer term wealth creation. In that what he saw out there, even back in his day in the investment community, was beauty contest investing, which he defined as trying to figure out ahead of time what the market would think the most attractive stock 6 months from now, to pick a date, short term. And that it was all about trading and trying to beat other people to be smarter than they are. And so when I listened to Zvi's question about beating the market, it's very clear to me that he's got this Keynesian notion of beauty contest investing in mind. And what happened to Keynes, and more he thought about this, and I think other people, when they think really hard about this, they recognize that there's a huge difference between this very real beauty contest investing that still goes on out there today and long-term wealth creation. In that the distinction then of the Canada model, and as Stefan, we're going to be talking about how that came about in the next little while, is that a key difference in these organizations is they don't do beauty contest investing. They're serious long horizon investors that actually try and understand cash flows. They try and understand business models. They try and understand the effectiveness of governance and figure out where there is a potential gap between price and value. And in many cases, also even beyond that, in private markets, to be part of the wealth creation process and actually creating the businesses. So this is a very different stage, very different perception, reality of investing as to what we should be doing with retirement savings than trading with each other in the marketplace to see who can beat who. So that's my answer, is that the Canadian model effectively has evolved from the thinking of both Keynes and then Peter Drucker in the context of what you need to do organizationally to make this work into a process, a reality that when you measure the longer term results against market results, yeah, they actually are higher. But it's not because everybody's trying to beat the market. It's because they're trying to sense investably and effectively.
Thank you, Keith. And to follow up on that one, I was thinking, for me, when I look at the world today, I see climate change as going to be a big driver of change, but so will also the aging demographics of the world. And these are more like trends that we haven't sort of experienced before. So there's a lot of uncertainty in there.
Right.
And I have a feeling that, you know, when that happens, a lot of wealth is going to change hand. Different kind of companies going to do good and the others are going to do bad. So in this kind of market circumstances we are facing as a long-term investors, is it not a bit dangerous then to just rely on the efficient market hypothesis?
Well, that's consistent with this whole notion that real investing is not trading. You know, it's not a beauty contest thing, that it is about the kind of things that you're describing. And what Andrew Lowe in his adaptive market hypothesis would say is tremendously important is that you understand the evolution of the social and the economic sides of investing, not just on a macro level, but that ultimately, you know, this stuff on the ground takes place at a micro level, one investment at the time. And that, especially if you bring in, for example, climate change now, I think it's apparent to anybody who's spent time thinking about this, that this is going to be an important driver of value creation and destruction over the course of the next 10 to 20 years. And therefore, if you're at all serious about investing, you better understand, you know, what's going on here, what's knowable, what's currently not knowable, and how that turns into an investment program that tries to be at the good side of this dynamic and hedges against the bad side of this dynamic. It's a very adaptive process.
So you would say it's a good idea to find the companies that are bad today, but has the potential to become good by changing the business. And if you think about valuation, some of the companies we all think is great today, they might be overvalued. So how would you sort of approach that?
So great leading question. The most recent winner of the Verton Award is, I want to get his name right, as with the Moradin. He's a prof at New York University, but he's kind of brought the whole thing around again to this notion where he, you know, his big thing is that in the efficient market, there is no gap between value and price. Prices always represent value by definition. Where he says, and this was part of his Verton Award, is that the interesting cases is where there is a gap between value and price. And that's where it requires business understanding to understand cash flows, to understand business models, to understand to what degree a rising price in carbon emissions is going to impact that business model. It's at very micro level that you're going to be making good or bad decisions, not at a market efficient level at all. So more than ever, I think today, we have to go back to the more fundamental aspects of investing and think about to what degree cash flows today and in the future are properly priced in the market and the degree which they're not properly priced, and how that should work into your investment program. Live, real time. Most recent Burton Award is exactly about the difference between price and value.
That's an interesting comment. And if you would take that one level further, you would say, what does it mean for pension funds today? Should we leave sort of the benchmark fixation with sort of market traded benchmark like MSCI World or something like that? And if we do that, what would be a good benchmark then for a pension fund?
Right. So I think where that leads you is when you look at it from a governance point of view as to ultimately, how do you, in today's world, if you're running a professional investment management pension organization, how do you think about incentive compensation for the people that are working in the organization? And what we're talking about here is this notion that part of that incentive should relate to redesigning the business model to adapt to current circumstances, and to hire the kind of people that you need to be effective under current circumstances, and away from this notion of beating the market. Now, I don't think you can get away from it totally, because I think a board does have to say, yeah, but this whole process should, over time, lead to being able to generate risk-adjusted net returns that that should look positive in relation to just passively investing in the market. And through CEM benchmarking, which now has a 30-year database on being able to answer this kind of question, the answer is a Canada type models and organizations to structuring these pension organizations, in fact, does produce higher rates, net rates of return than generally passive strategy. So there's a completeness, if you like, in both a priori what should be the case and what data is telling me is actually playing out to be the case.
One challenge that I see if you look in the market of DC is that it's sort of quite a heavy price pressure on investment services. So, and what you're describing is what I would think of as sort of almost like a stock selection, quite expensive because you need good competences and so forth. And you need a big team, so you need quite a large volume of assets under management to be able to implement it. While you have the pressure for most organizations that whatever price you charge today is too high, it should go down. How do you marry this sort of pressure for price down with this sort of what you should do for the long term?
Right. So now we're into the really important question of pension system design. And I like the notion, the World Bank notion of pillar 1, pillar 2, pillar 3, because it helps us with this kind of conversation where generally pillar 1, it's government based, it's pay go, covers everybody, some base. The flip side of that pillar 3 is where you leave people on their own. And that's where the asymmetric information problem comes to the fore, because if you leave people who are not familiar with what's really going on in the investment world to make savings and investment decisions, or be guided to do so potentially by organizations that have an interest in high cost solutions rather than low cost solutions, you have a problem. And so to me, it's all about pillar 2. The pillar of collectively creating systems that are large enough, scaled enough, and effective enough where workers, retirees can safely and comfortably leave their accumulated retirement savings and have them managed in a professional way. So this is one, I think, the huge challenges today in the world, in the retirement income world, is how do we create more effective pillar 2 systems that can collectively think about risk sharing, about creating the kind of outcomes that allow people to have affordable pensions that are also adequate.
Yeah, and I think even in the Pillar 2 situation, I remember from up in Sweden, but also see it in the UK, that there's an extreme price pressure on the Pillar 2 solution. So even if you are in that place, you're going to get a cheap solution, but for the people investing the money, it's going to be difficult to implement the Canadian solution because the price pressure is so high. So you almost become, it's a difficult sort of discussion. It's a difficult sort of to find the right balance there. Of course, it shouldn't cost too much, but on the other hand, if you've been price pressured to the limit, only thing you can do is offer beauty contest type of investing with really cheaply.
Right. So we've got this this wonderful laboratory on the other side of the world from where we are, down under in Australia, who've been running effectively a DC system collectively now for 30 years. And so we have an interesting laboratory there in terms of, how does all that play out? And what you find, not surprisingly, is, the logic, again, the Drucker type logic, again, works out, where what are the kind of organizations that are best, serving the Australian super system? Well, they're the kind of organizations that we're describing. They've got scale, they've got good governance, they act in the best interest of the member. I love the term profit for members rather than profit for shareholders. And guess what? It works. The other interesting thing now that they've had this multi-decade period of accumulation of retirement savings. The big challenge there now, and it gets actually into your next conversation with your next speaker, is the back end of how do you create decumulation that also has longevity risk pooling attached into it. Again, at a scale, run professionally so that it actually works in practice. The Australians can show it can be done, whether you have one pool or where you have multiple pools. Again, what's required is the trust of the participants in the management of their retirement savings so that they don't go shopping for different players every year because somebody's performance is higher than somebody else's performance.
Another question which sort of pops up in my mind is, we talk about the beauty contest investing, but what could you do instead if you are, as a long-term investor today, if you do have the opportunity to say, I want to look beyond the beauty contest, I want to do something real, what would that be? What kind of, how do you get there based on your experience?
And the short answer is it's not easy. Part of what I do in this letter, and I've done it other places as well, is to kind of just tell the story of the origins of the Canadian pension model and how it came about. And it took some good thinking at the front end, the sort of the Keynesian, Druckerian kind of thinking, but it also takes leadership by real people to actually create the kind of organizations capable of actually executing in that world. And so it's interesting that, for example, what went right at the beginning of the Canadian model is with Ontario teachers was a strong board who hired an entrepreneurial CEO, who hired an entrepreneurial CIO, who thought about how do we turn our $20 billion of non-marketable government debentures into the kind of program that makes sense given our liabilities. And instead of going the sort of the old route of slowly hiring third-party money managers and having lots of beauty contests, they said, we need to be in real estate. Now, what do we do? And what they ended up doing was privatizing Canada's largest publicly traded real estate company, Cadillac Fairview, and made it their investment or their real estate investment arm. So here we are 25 years later, it's still one of Canada's largest real estate companies, wholly owned by Ontario teachers. It's been a tremendous investment for them for 25 years. It's an example of the kind of thinking that we need to foster in the retirement savings world in order to get the kind of results that we need to get, the returns that we need to generate in order for people to have pensions that actually are enough at prices and contribution rates that are reasonable and affordable.
I recall from my time up in Sweden that the AP funds have a similar approach with their property investment. It's called Vasakronan, and the different AP funds are owners of that company and set the agenda and set the risk preferences and the strategy. But also it helps that company to be very long term, and they can buy contracyclical when it comes to the real estate market. So it is a way to go if you're big enough.
If you're big enough. So again, it's this question, and this is partially a public policy question of how do we create scale, the kind of scale that we need and the governance that we need to make this stuff go the way it can and should go.
Well, another question for you, Keith, is that you talked a lot about Ontario Teaching. You talked about the people in there and how important the people dimension is. And I also know that you're running these trustee education courses. And what's your experience of sitting down, talking with trustees about this, of pension schemes, and trying to sort of get them thinking about how to solve things? What is sort of your experience from those discussions? I think you made, what's it, like 15, run this course 15 times or something. So it's quite, quite
I
a
think
big
it's
database.
13 or 14 times. You know, haven't run it in the last couple of years because we haven't been able to get together. But it's been an interesting experience running these. It's typically 30 people. They're together for a week. They're board members from multiple pension organizations in multiple countries. And one of the things they love about the week is actually to be able to exchange, meet a bunch of peers they would otherwise never meet and discuss common challenges. A couple of things. One is, and it's kind of a difficult one, which is that, there is a body of management theory around the requirement for strategic thinking in order to accomplish complex goals. And in that space, running a retirement income system is a pretty complex enterprise, which requires fairly high levels of strategic thinking in order for things to be put in place and run the way they should be run. And so one of the issues you have are the selection processes that put these trustees in the place of being on a board of an organization. Do they reflect that reality? And I can tell you, in reality, in many cases, they don't. So in a number, more than a few cases, you have a mismatch, if you like, between what's required in terms of strategic thinking capability and the people on that board to deliver that. So that's a huge challenge that's not easy to solve. The other part of the week is you can do a little bit of hard theory, but not too much, because number one, they don't find it all that interesting except to see where it fits in their jobs. But the more practical side are the case studies around, which organization was successful in achieving this goal and how did they go about doing that? What were the key success drivers? And then the other thing we do in that week, towards the end of the week, we give them, divide them into small groups and give them a problem to solve based on what they learned over the course of the week. So the final Friday morning is show and tell, where you've got 5 groups, each with a problem that they're going to recommend to the rest of the group as to how to solve that problem. And it's a fascinating experience to sit there and listen to these people who've only been together as this group one afternoon and evening before they present the following morning, how well they do in terms of defining the problem and coming up with creative solutions. So it's been a terrific experience, and hopefully by sometime this fall, we can get it back on the road.
Sounds great, Keith. I remember I had a bit of a mischief moment, I think 10 years ago, and I wrote a piece called Choosing to Fail Conventionally. I nicked Keynes' title, and I made a sort of the list of 10 things you should do if you just want to coast through your career and sort of not sort of having to make any difficult decisions. And I remember I wrote as anonymous, so people were always wondering who's the one who wrote it. but then I remember some feedback I got through you from an Asian sovereign wealth fund, someone working there, and the answer was, how did you know my organization so well? So this seems to be a global challenge for everyone. But my question is, how can you break through the glass roof? Because status quo bias is very strong, and it's very difficult to do something different. So how do you sort of get people to break through the glass? What were sort of topics you used, and how do you discuss that with the trustees in your course?
So yeah, I think it goes right to the heart of the matter. And again, if you go back to the sort of, the Ontario Teachers Creation example, the key decision that board made when they were looking for a CEO was out of the box thinking, entrepreneurial thinking that could take the plan away from what it used to be doing to a better world. So they actually actively looked for a change creator. And then he in turn looked for people that could work with him on achieving that kind of goal. And in fact, Claude tells a story that the first private deal that they brought to the board and got approved failed.
Yeah.
And they had to go back to the board a year later and say, we blew it up. It didn't work. And the board said, so what did you learn? And since they got it right for over a very long period of time, and I don't know today, but a lot of what they do today, as well as other Canadian funds, is not in public markets anymore. I mean, they're certainly there, but they're also very significantly in private markets, where they end up being very much closer to the organization, to how it works, to how the governance works, to what their business plan is, how the compensation works. So they're very much more integrated, if you like, in the wealth creation process than simply being a beauty contest investor that just buys and sells pieces of paper.
Thank you, Keith. We started getting some questions here in the chat. So my call to everyone is, think about what you want to ask Keith. You have a unique opportunity here to actually ask your question and see how Keith can help you resolve that. So I have a bunch of questions from Bernard Casey here. So let's start with the first one. Was Samuelson playing a part in the beauty contest game, or a gambler's game, or what?
This is a question. I assume this is Paul Samuelson.
Yeah.
I actually sat beside him once in a meeting at TA Cref back in the late 1960s. So I had a chance to ask, late 1970s, I had a chance to ask him that question, but I didn't have the question at the time. I can't tell you song and verse now in terms of Samuelson and where he is in this sort of beliefs, this thinking around market efficiency. My sense is, I think that in a sense, everybody's right that yes, if you're talking about the beauty contest version of investing, that is a game that's destined to fail. And I think Samuelson understood that as well as other people who have thought about it. Where he was on the more Keynesian wealth creation side, I don't really know. Never had the conversation.
Another question from Bernard is, Warren Buffett made his gain because he internalized the costs, or so say John Kay, who taught me.
Yeah. So I give you a really good example. This comes from the CEM database, where they've actually divided the private equity investing programs of many different pension organizations into 3 categories. One is internally managed, where the work's actually done and the deals are done through an internal group. The second is where they're outsourced to an outside leading partner. And the third is where they go to a fund to funds approach, where they basically give the money to someone who in turn finds a bunch of private equity opportunities and spreads the money across them. And the benchmark against which the results were evaluated was a mid-cap, global mid-cap equity index, as kind of an approximation of, you know, the kind of money and the kind of investments that were being made. And the results were very much in line with what I would have expected, which is that the insourced money, which had much lower cost, in fact, had an average excess return of about 2% relative to this index. The outsourced directly to a single fund produced market-like returns. In other words, you know, the gross returns were higher, but the costs were higher, so net there was no net gain. And the fund to funds approach lost 2% per year on average. So it's costs matter a lot.
Yeah, and here I have another question from David Bird. It says, in the UK, which are the pension funds or other organizations who are doing the best job? And do you know why?
The reality is okay, I'm not a total expert on the UK market, but I know enough to know that what I've been describing as sort of the Canada model had never made it to the UK. So, and I think the other element that structure the market in their pillar two, there were just a lot of small employers that sort of did their own thing, had their own DB plans. And then you have another factor, which is sort of professional trustees, where you actually have a business called being a trustee. And you put all those pieces together, and it's going to be very difficult for the system, you know, to generate significant value, is my sense. So, you know, given those realities, the new wave in the UK, I think, has got, you know, a better shot now of this mandatory participation requirement that came in. The launch of Nest as I think an organization that was put together in the right way for the right reasons with the right people. And now some of the other organizations, like Now, for example, or People's Pension. So I think, you know, that's the hope, my hope for the UK. USS is another sort of interesting, you know, large end of the scale example of an organization that's got some very good attributes, but it has some huge issues around the pension deal, about, you know, different groups having different perceptions of who owes what to who and who's bearing what risk. I don't think the regulator is playing a particularly useful role in that whole discussion. So it's a bit of a mess for sort of deal reasons. And again, sort of interestingly, what's evolved with the Canadian model is that the trustees have played a more proactive role in evolving the pension deal over time, of basically saying, you know, we can't do hardcore guarantees anymore. You know, it has to be conditional. Let's figure out how to do sort of put conditionality into the pension deal in a way that people understand it and it's perceived to be fair, and drive on from there. So I think that when you look at what's happening in Canada, the evolution of these collective systems, it's evolved over time in a way that's been generally constructive, where I think in the UK that has sort of not been the case as far as I've been able to, you know, sort of look at what's happening in the UK.
Thank you, Keith. And I would sort of agree with you that with the introduction of master trust, there is actually a way to build these organizations that are going to be able to have over time a sufficient assets under management to actually start considering thinking along the lines you have been discussing. But I think there still are some years of growth before they get there. But
yeah,
is a good thing in the right direction. There's a question from David Toyne. He says, thinking about Pillar 2 pensions, what would Keith advise is more important to outcomes, cost/fees or asset mix, or something else? And insights into typical asset mixes in these schemes. The schemes that you have been described, so to say.
Right. It's a package. You can't segment. Again, you have to go back to Drucker. And when he wrote his book, his one and only book out of 39 books on the pensions world in 1976, one of his key messages was that when we start thinking about how to create effective pension organizations, the rules are no different for pension organizations than they are for any other effective organization in terms of, clarity of purpose, why you're there, good governance, clear business model, ability to execute, being able to attract and retain the right kind of people. It's no different. So the notion that you can distinguish between costs and asset mix, it's all part of the package. The costs are lower in the Canada model because of this ability to insource and to actually attract people internally that the pension funds in a lot of other countries cannot do. So cost is part of the story. But I think the other part of the story is moving into that intermediate space of real estate infrastructure, sort of, lower risk investments that still require significant sort of analytical capability, deal-making capability as to how you put them together and how you make them work. But, again, the Canada Model Fund it played a large role in that middle space of real estate and infrastructure through their own groups internally. And that piece of asset mix, I think, has been very beneficial in the sense that it's generated good returns at relatively low levels of risk. And again, what's risk? There's very little volatility because, it's through time because they're private investments and they get marked based on some formula over time. But more importantly, underlying is the cash flow has been, pretty much in line with the expectations, which is, the real test of success.
But Keith, if I want to challenge that a bit, when I looked at it years ago, the Canadians were the first one to do it. No one else done it. So they could buy a lot of their assets at a very attractive price because there was no competition. And now this is a very hot market. Everybody want to get into infrastructure and so forth. So I think maybe today you're not going to see the returns anymore because now it became a mainstream market. Historically was pretty much a maverick market.
Right. So a counterpoint is I just did a blind review of an article. So I don't know who wrote it, but it was around Canadian funds investing in real estate. And what they went through and kind of showed the strategy as to how they put the pieces together in terms of, the sustainability side, the location side, and some other criteria, and then showed how that was actually executed. That's a very interesting article. And again, the question becomes, where are the organizations that can put all those pieces together in a sensible way? And then I think the other thing is distribution, where in many cases, if the fund doesn't want to do all of it itself, it now has some other funds it knows and trusts. And by the way, they're not just Canadian, there's now an international group of these funds that know each other, that trust each other, that will go syndicate to each other in some of these deals. So I think there's still a significant comparative advantage there in how they actually execute what they do.
Thank you, Keith. We have a question from David Bird here, and he says, there seems to be a tension for DC savers between a good investment model and allowing members to have choice. How should this be squared? Because I think when you talk about the Canadian funds, it's more or less DB type of schemes where you basically, if you have a pension right, then you have very little choice in there. So, but in many places, you basically need to offer member choice. How do you deal with that in this sort of extra dimension?
So again, let's go to Australia, where you do have individual pension accounts with large super funds. And again, there's the default option, and then there's some additional choices. And not surprisingly, what you find is most of the money, most of the time, is in the default option. Because these are people that understand that if they try and second guess, they're professional managers. What are they doing? There is also in Australia, and there is a version of a Pillar 3 where people are left to their own devices. And again, the research Pillar 3 behavior anywhere in the world is completely predictable. And on average, people pay way too much for what they get out. And it's completely predictable, given on sort of the Schiller-Akerlof fishing for fools informational asymmetry story. So it's in the interest of a segment of the professional investment community to sell these high fee solutions to people who really don't have the ability to assess the claims. That will continue to be the case as long as it's legal. But in societal interest, the more that we can get of this money, we can get into fiduciary managed, profit for member type of arrangements, the better off everybody is.
Yeah, Bernard, I think he had a follow-up question on the Australian part. I think you touched upon it. And that was basically, on the one hand, sort of the second pillar seems to do fine in Australia, but then you have a lot of people who ended up with banks. And actually the regulator in Australia had a review and was very harsh on the banks and how they treated the customers. So but it is a challenge.
It's a great story, and it fits exactly with our conversation here, because what happened at the beginning when these super funds, this mandatory scheme was set up in Australia in 1990-ish, there were these two kinds of super funds that were legalized. One was basically union driven, where the unions or the state created a super fund or multiple super funds, and the banks could also create super funds. And there was an ability to compete over time. So you had this classic case of ex ante. You had, one segment of the retirement savings were being managed on a profit for members basis. The other segment was being managed on a profit for shareholders basis. Guess what the differential returns were over a 25-year period? 2% per year. That's what created the hearings, parliamentary hearings in Australia, including bank CEOs in front of television sets being asked to explain how this could happen. That was very much, I think, an indirect advertisement for the profit for members solution as the right answer to how these organizations should be structured. If you don't have an alignment of interest, you typically run into problems very quickly.
Okay, and then I think Bernard's question was also around that a lot of people are shifting jobs in Australia and the pots are sort of getting lost. I think you have the same situation in the UK as well, because even if you have mandatory participation in a master trust, when you shift job, you don't typically go and trying to say, okay, let's move all my money to one place. So you end up having a lot of lost pots in many places. Yeah,
that's, I think it's recognized as an issue in both the UK and the Australian markets. And, I can't sort of I know there are solutions being proposed to deal with the problem. I'm just not an expert on exactly what those solutions are, but it's definitely an issue.
Here's another question from Dirk Broders in Netherlands. Good to see you, Keith. An interesting area for socioeconomics is the payment of benefits over time across generations. if pension funds are wealthy or are running shortfalls, different generations will collide. How to best manage this over many decades to the satisfaction of all generations?
Right. That's a really tricky question, and I'm aware that this intergenerational fairness challenge is a significant challenge. And of course, one way to get around it is to go to individually owned investment accounts, as is exactly what's happening in the Netherlands, partially because of the perceived inability to solve this intergenerational problem. The Canadian funds have gone a different way, interestingly led by the boards of these organizations, saying, yes, we understand the need for intergenerational fairness, but do we have to go to individual accounts, to achieve it, or can we stay collective? And the route that they've gone is to stay collective. But at the same time, to figure out, how do you create mechanisms, adjustment mechanisms in the system so that it can self-correct itself. And my criticism of the Dutch model has been over time is this solvency overlay where you have the solvency test for the plan every year. And my gosh, if you're under 100%, bad things happen. Where in Canada, the approach has been quite different, which is not to go to a solvency test approach, but to go to a reasonable test approach, which basically says, number one, is the system fair in terms of who's bearing what risk? And part of that was to create conditional inflation protection for pensioners, so that they're clearly part of the risk-bearing group and that they don't get off scot-free. So that was an important element in the evolution of the Canadian pension deal, Pillar 2 pension deal, was to create that sort of contingency. The other interesting question is the discount rate, as to what discount rate you use to evaluate whether you have enough money. And the Dutch went the complete route, solvency route, of going to risk-free discount rates. In a going concern world, that's irrelevant. You're not going to solve, or you're not going to wind the system up next year. It's more a question of going concern. How do you keep it going over time in the fairest way possible? And so that's led to using discount rates which are significantly lower than expected return on equity, but significantly higher than the risk-free rate. So for example, right now, I think Ontario Teachers is using something like 2.5% real as the basis on which they create the funding target. And they evaluate their actual assets against a funding target that assumes a 2.5 real net real return. So I'm quite comfortable with that approach to a sustainable long-term system that takes into account this notion of intergenerational fairness, what I do think is important. The counterpoint is, of course, our friends south of the border here, which haven't had that ability, that conditionality in what they do. And because, again, the governance processes are fairly much politicized. You get elected board members that have short-term interests. So you end up with very high discount rates, which means, lower pension target or liability targets now, but potential significant holes down the road. So it's really a balancing act that I think can be done collectively. But if you don't think you can do it collectively, then you need to go to an individual approach where people own their own retirement savings accounts, but still can collectively set up schemes to pool longevity risk at the back end.
Keith, I would say what I've learned over the years thinking about pension is that it has to be simple. You have to be able to explain it to someone. And the more complex you make it, the more difficult it is. And if people can't understand it, it's difficult to trust stuff. So I've come to the conclusion, I think the route in Netherlands is pretty good, that where they get individual pots and you add sort of longevity pooling at the end, because it's a clear, transparent, easy to explain solution. And that I think is worth a lot. Maybe you can do something technically advanced, but if you're going to spend a lot of time thinking about it, it's going to be difficult.
Right.
With that, okay, Keith.
The other thing I would just say is that one of the problems in this whole discussion is short-term volatility, and a lot of that short-term volatility is not economics related.
Yeah.
And yet, if you start behaving as though it is economics related, you start doing things like what happened in the Netherlands, which is to adjust your benefits based on short-term volatility, which is just fundamentally wrong. So, one of the ways of getting around it, of course, is to go to private markets where you value the assets based on some formula over time, and you don't have any market volatility at all. So that's
don't go there with me, Keith,
prospect.
Because I'm going to get really upset about that, because that's you're just doing book valuation and hope the problem is gone. But keep that thought, because now you have the chance to ask a question to our next speaker, and that's going to be an interesting part. Thinking about how you're going to deal with longevity. So Richard Fulmer, he spent quite some time thinking about this, and how can you put this as on top of an existing sort of investment scheme and add this as another feature, and that way create sort of a DC plus saving scheme that's going to give you a lifelong income. So when you're thinking about this problem, what is the question you would like to ask Richard?
I think the key thing is implementation. And I think, well, the design is also important. And I think one of the interesting things about creating these pools is who's in the pool, the demographics of the people in the pool. To what degree are they either close, identical, or if they're not, how do you deal with that disparity in how you basically reallocate the credits from the people who die and whose capital goes somewhere else. So that's, I think, an interesting design question in how you do that. But maybe the more challenging one is, how do you make it work in the real world? In other words, how do you actually create an offering that that survives and lives in the real world? And what's encouraging to me now is that you've got the Australian example. Q Super has created one of these pools. In Canada, there's been a pool created through the mutual fund sector under securities law rather than pension law. And so I think the interesting question for Richard is, what's the best way to actually not only design it theoretically, but to practically bring it out into the marketplace so it gets used by a lot of people to their advantage.
Thank you, Keith. I will forward this question to Richard. We're running out of time, so I would thank you a lot, Keith, for coming here and sharing your wisdom with us. And I would like to thank everyone in the audience for spending some time with us and for all your good questions. So until next time, looking forward to see you. And then we're going to get an answer to Keith's last question. So thank you, Keith, and see you soon.